Today's podcast is sponsored by Fintool. Still control Fing through SEC filings? There's a better way. Meet Fintool, the chat GPT for SEC filings and earnings transcripts. Just ask your question and Fintool pulls the best answer from relevant documents, whether it's a snippet from an earnings call or a key point from a filing. The best part, every answer comes with sources, so you know exactly where the information came from. That's their read, but let me give you a little bit of my experience. I've been really interested in gaming stocks recently. So I was looking at Caesars, and Caesars has been built up through a slew of mergers over the year. I wanted to see their thoughts on how the synergies from these mergers had evolved to kind of judge them on these mergers. Previously, that would have been a half-day project. I need to pull up every earnings call for the past 5 years. I need to go through it, control F for synergies, probably read through it because sometimes they don't say synergies directly. They say like merger benefits or something. And I'd have to go through all of them and see how the thoughts on synergies had evolved. But with Fintool, it only takes 2 seconds. I just say, what did Caesar say about their Eldorado deal synergies? And Fintool gives me a quote and a link to the source. In this case, it points me to Caesar's 2023 proxy that's noted they'd exceeded their stated synergy target. And then if I want to do more, I can ask them some different questions and find out more about how the synergies have evolved over time. Good luck finding that with Control F in just 2 seconds. So look, if you're an analyst or a portfolio manager, try Fintool today at fintool.com and take your research to the next level. That's fintool.com. All right. Hello and welcome to the Yet Another Value podcast. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on my friend, the CIO of Outerbridge, Rory Wallace. Rory, how's it going?
Going well, Andrew. How are you?
Doing great. Look, thanks for coming on. I'm super excited about the podcast, the company we're going to talk about today. But let me just start this podcast the way I do every podcast. A quick disclaimer, remind everyone, nothing on this podcast is investing advice. That's always true, but this is an internationally domiciled company. They trade locally. They're on the smaller side, and both of those carry extra risk. So everybody should just remember, not a financial advice, consult a financial advisor, do your own work, all that sort of stuff. Anyway, Rory, the company we are going to talk about today is Allot. The ticker there is ALLT. I was telling you before, I'm super excited to talk about it because as I was doing my work, I was like, I can ask questions about like, is this a 10 bagger? Or I can ask questions, is this dead money for the next 10 years? So I'll pause there, toss it over to you. What is Allot and why are they so interesting?
So very, very well set up there, Andrew. I think it's been quite a journey at Allot, and you can see that as evidenced by the stock price, which, as you mentioned, was worse than dead money for the better part of the last 10 years. It was pretty much in a downtrend, and it's recently had a significant re-rating, although the company is still only valued around $250 million today, playing in a TAM that we think is valued probably around $10 billion when you aggregate the different markets they're serving. So still a lot of opportunity, but a lot to talk about. I would say at a high level, Allot is a niche networking technology solutions provider to telecom operators. So company that came up in embedding itself in the core of tier one carrier networks, providing deep packet inspection equipment, which essentially is used to scan traffic that goes through the network and then apply policy on that traffic. So, for example, there was services like Napster and LimeWire that were very popular back when you and I were a little bit younger. And so Sandvine, actually a topical company that we'll speak about today, they were a provider to Comcast, and Comcast used them to shut down certain power users of Napster and LimeWire, basically to allow the network to have more resources. And there were a whole bunch of things that came out of that at the time. It's very powerful technology, as you can imagine, scanning every packet that goes through the network, being able to discriminate, is this Facebook, Twitter, a video game on an application level, and then providing that reporting back to the carrier and applying policies such as shutting off the user in certain cases or charging different rates for different users. So very, very powerful, but very niche. This was a technology that throughout most of the last 20 years, it was about a $500 million TAM for a handful of vendors to participate in. And the reason that it didn't really broaden out is this is sort of a Ferrari type product. And for a lot of operators, they'll deploy DPI, but they're not going to grow that deployment necessarily every year. It's doing for them what they want it to do. They'll refresh it when there's a new product cycle, but there wasn't a lot of growth. And so initially valuations for these DPI companies had been priced for long-term sustained growth, call it 5-6 times revenue multiples. And then what happened was, especially coming out of an upcycle in the 2010 timeframe, there was just a stagnation in the market. And you saw Sandvine, Procera, and Allot, the three publicly traded DPI companies at that point, all enter downturns in their stock prices. Ultimately, Procera and Sandvine merged under the ownership of Francisco Partners, and Allot was left as the sort of last man standing. Now, the reason why I think it's so interesting right now is, in addition to that deep packet inspection business, which we think is actually starting to develop some real tailwinds going into the next several years. But in addition to that business, Allot took itself and that incumbency that it had as a trusted provider in the core of the carrier network, and they expanded outside of that to become a cybersecurity company with the goal of delivering cybersecurity solutions to consumers and small businesses that would be installed in the core of the carrier network, would require no installation by the end user, and thus could get a very high adoption rate. We know that in technology with products, friction is everything. So if you have something that has friction to download and install and patch, you might get very low adoption. But if you have something that's so easy that I just click a button and it's turned on and I'm protected and I'm satisfied and there's no degradation of service, that's a product that Allot believed a very high rate of consumers and businesses would want. So they had the vision to expand their market, pivot in that direction. Of course, pivots don't always come without some turbulence. And so, I'll turn it back to you. I'm sure you have some questions to ask about specifically what might have went right and wrong with that sort of pivot into cybersecurity, the business that they call security as a service, or CCAS.
No, I actually do have quite a few questions, and I have a few questions on what you just said, but let me start this podcast the way I do every podcast, because I think it makes a nice soundbite, and I think it sets it up for the rest of the podcast. The market is a really competitive place. I will say, there are good articles across the internet. You read the companies, you listen to the company news call, you're going to pick up on the story in CCAS pretty quickly. What do you think you are seeing that the market is missing that makes this a risk-adjusted alpha opportunity, given it's not like they're hiding the ball on this?
Yeah, I think that's right. I think what you saw, and we'll get into this more, I'm sure, but you saw a period of disappointment where CCAS, they'd given some very ambitious targets for this business on the basis of having a tentpole deal with Vodafone and assuming that they would be able to sort of replicate that same pace of success at every other customer that signed with them. And what ended up happening was they gave a target of about $25 million for CCAS revenue in 2022. For a time, there was a lot of excitement from investors that were involved. And they ended up having to take down numbers for, I think, 8, 12 straight quarters in a row, very long time. Numbers consistently came down. And, for you and I and most investors, we look at that type of a setup and we say this thesis must be broken. This product must not be actually as valuable as they say. And the view that, I have on this situation, having done a lot of research, is they essentially were correct on the value proposition of CCAS. And where they struggled was with the realistic timeline to implementation and revenue generation. They were just overly optimistic. And unfortunately, that optimism filtered down into how they ran the P&L. And so you saw a company that was burning cash for a long time. And as a function of all this disappointment, the stock had dropped to a low level. Analysts had dropped coverage. I think a lot of people gave up on the name. More recently, that's changed. And there are some really good articles you can read on Seeking Alpha, for example, on the situation and how it's pivoting. But I think where we have a sort of differentiated and alpha-rich view is this is a company where, unless you went out and you spoke to customers, maybe went to some conferences, they have a big one in Spain called MWC, and sort of got a real pulse of what was going on, you could easily look at the P&L and say revenues are down for 4 years. This is just a secular declining company. Probably it should just be fire sold. But throughout the last couple of years, as we've been involved and also increased our position, it's really been a situation where, we've been hearing very positive things. And that included that Verizon was really happy. Verizon, for example, the largest US tier 1 carrier, 100 million, consumer mobile lines and 30 million business mobile lines. They signed a deal with Allot back in 2022, but it didn't launch until the middle of 2023. It launched very incrementally. And so the initial revenue build was, adding 100,000, 200,000 of revenue at a time, not millions at a time. And so for investors from a distance, it didn't look all that game changing. But what we learned upon doing our research was that Verizon's very happy with it, and they were looking to expand it in a very significant way, such that the ultimate scaling of that product could reach a couple $100 million in annual recurring revenue. And we believe that actually recently occurred, where there was a significant expansion we think happened. Important to note, this has not been press released by Verizon or Allot. And so we're going off of our knowledge of the product and specifications and the marketing that Verizon is doing around it. We do not have certainty on this, but it appears to us that Verizon now has expanded that deal. And we had, similar revelations around Vodafone, which also recently expanded its deal and has publicly talked about that with Allot. And so I think the variant view is that, look, this was always an exciting story. The execution was lacking for a time. The vision was overly ambitious and not risk weighted enough in the way that they ran the company. Now that's all changed. You have a company with a free cash flow positive cost structure, and you're coming off of kind of a 10-year low in the DPI business, which we think is poised to rebound as well for several different reasons. So I think that the view that I have of this company is in a few years, it's going to be, $200, $300 million top line company growing at a high rate with very high incremental margins. And that's clearly not priced into the stock because, even after the move, it's trading at around, $250 million EV on, if that would be a 1x multiple on a, 25-30% grower with significant profitability. We know the market would value the company higher if our vision comes to be true.
Let me pause you there because it's funny. The questions I got the most were on stock price. And I'm going to come back to those, right? People can go look at the stock price. You and I know we scheduled this in December and the stock was 3 and the stock is 7 now. So I think we're going to talk about all the reasons alpha, but the most common questions I got was, is this still interesting after the stock move? And then the other questions I got was, I looked at this in 2015 and the stock was where it is today. But let's come back to all that. My key fundamental question I had for you, I've looked at businesses like this in the past, and my big worry here is they have a partnership with Verizon and Vodafone, and that is great, right? They're providing, correct me if I'm wrong, security as a service, and it's mainly for their business customers. I think particularly Verizon, it's the fixed wireless access business side, right? I guess my question I always have, and my worry I always have, because I've seen some of these businesses before, is it always sounds great. Verizon has 70 million customers in the United States. If 50% of them sign up and they pay $2 a month, and our share of that $2 a month is 25%, to the moon, 100 million plus in annual recurring revenue. And it always sounds great. But my worry is the value is in the distribution, right? Verizon has all the value. And every time they come back to Allot, they say, hey, we like your product a lot. I like that pun. We like your product a lot. But this is a buy versus build decision for us, right? We could build this internally and keep in my example, 50 cents that we're giving you, we can keep that for ourselves. So always looking at the buy versus build. And then B, look, you provide a great service. We like it, but it's not like you're the only guys in town. So we go to anyone else and we say, hey, we're Verizon. Allot's charging us 50 cents per customer per month over our 70 million. We'll switch it all over to you for if you charge 45 cents, right? And obviously there's switching costs, there's stickiness, but those are the two worries I have. I worry that basically in economic terms, I worry all the economic terms goes to the Verizon and eventually like a lot kind of gets sucked out. So I will pause there. I can provide lots of other examples I thought of, but I'll pause there and I'd love to hear your, because I think that is the key fundamental question here.
Yeah, I think it's one of them. And I think, the probably one of the least fun jobs you can have, I would guess, is being a salesperson structuring a contract going to a large tier one like Verizon or Vodafone. They have professional procurement teams that are designed to beat up on vendors, run bake-offs constantly. And I think, that is definitely some of the legacy of the space and some of the reticence that people have when they look at investing in a company like Allot. I'll make a few points. There are companies with a lot of customer concentration on the operator side. A company that's actually performed really well that comes to mind is Harmonic, where they have about 70-80% revenue concentration as a predominantly network infrastructure provider to Comcast and Charter. Now, they've been able to extract reasonable terms on renewal with these partners from what we can observe in the public financials. And it all comes down to value delivery, right? How much value is being delivered by the vendor? How commoditized or not is the offering? And ultimately, how strategic is this to the operator? Because I think it cuts two ways, right? It's very painful. It takes many years to get in as a supplier to the core of Verizon's network. This is something that's integrated at the core of their network. So it takes a long time to get there. It also takes a long time for someone else to come in and unseat you. And I think one of the sort of magical elements of Allot's positioning here is that it's a very large TAM for a small cap company like Allot, $5 billion. So TAM. By the way, it's consumer and small business. So the Verizon product.
I thought the majority was on yeah. Okay, perfect.
Yeah, the Verizon's business, but actually like Taiwan Far East Tone, for example, which is the largest operator in Taiwan. They have a very successful offering with Allot on the consumer side. Vodafone actually offers it only to consumers currently. Telefonica has it for businesses. So it's both business and consumer. And the sort of magic here is the TAM is big for a small cap company, but it's not so big that you're bringing in a million different competitors and venture companies that are chasing you. There's not that many players out there. And specifically with what Allot does, they leveraging that incumbency and knowledge of being a DPI provider, scanning traffic, classifying traffic, looking at metadata, looking at patterns and anomalous usage, and providing that back to the operators. They do that on a security basis so that they're actually scanning the traffic in the network as opposed to what every other vendor in the space that goes to the telco and signs them up for a similar service does, which is they look at the DNS. And a DNS lookup is just not as resilient. It's not as robust. It's quite easy to evade in certain scenarios, and it's lighter weight. It's easier to install, but it's ultimately a more commodity-like offering. Whereas what Allot offers is very robust. And I think for the Vodafone question, right? So Vodafone actually got basically a free lunch when they first did the deal with Allot, because Allot sold a lot of DPI to Vodafone. And they said to Vodafone back in 2013, 2014, well, let's do this security deal and we'll sell you a license for all your customers, And so Vodafone said, okay, great, we'll pay Allot. I'm making up numbers here, $5 million. We get an all we can eat license. And then not 3 years later, but Vodafone was on their earnings call talking about how this SecureNet offering powered by Allot was making $160 million in annual revenue. And so Allot had just sort of sold away the farm to seed the market. I think it was a wise decision, but they weren't capturing even a fraction of those economics. And so now 10 years later, coming up on a big renewal with Vodafone that happened last year, and you can, listen to the conference calls, you can go to the transcripts, you can see what's happened, which is that Allot has expanded the Vodafone deal. They're now offering more products to Vodafone, including for, home internet in addition to the mobile network. And they're getting expanded economics. They're talking very clearly about moving to a CCAS deal off of the perpetual license. They're talking about growth. So Vodafone literally had 10 years to do something different. And, they ended up coming back to where they began and upsizing with Allot. And that doesn't guarantee future success. But I think it can give you some comfort that what they're doing here is a little more differentiated. And with Verizon, Verizon is really emphasizing these what they call cloud-based security offerings that are zero touch, really easy to install. They're really leaning in, if you look at their website, around the business internet security, which we know that Allot powers, business mobile internet security, which we think they recently expanded to. And you can see that this is a point of emphasis and pride for Verizon. And we don't think they have any plans to try to switch Allot out. Pricing, I think, is always a consideration, but you also have to think about the operator itself is making revenue off this, right? So there are, a lot of telco equipment companies, including even something like a Harmonic, which we think is a great company, that's sold on a TCO, basis of we're going to save you maintenance costs, or we're going to save you something, so you should buy this. But Allot is actually, this is something your customers are paying for. And in the case of Verizon, we think there was a CCAS transcript which talked about 50% plus attach when the product was offered to a customer. And so if Verizon's bringing home tens of millions, hundreds of millions of revenue, that's a big win for some C-level people in the business group, right? And they're probably not looking at yeah.
A reminder that today's podcast is sponsored by Fintool.com, the chat GPT for SEC filings and earnings transcripts. Just ask your question and Fintool will pull the best answer from the relevant documents, whether it's a snippet from an earnings call or a key point from a filing. If you're an analyst or portfolio manager, try Fintool today at Fintool.com and take your research to the next level. That's Fintool.com.
Yeah, because I did want to ask about that, right? So if I'm the customer, right, I've got a small business and Verizon's providing my internet, my cell phone in some way, shape, or form, right? Mm-hmm. I just know for me personally, when I sign up for broadband, and then the cable company always comes to me and they're like, hey, do you want to get our home security? Do you want to get, and for me, it's no. This is a very, you get the rental car and they say, do you want the rental car insurance? And everyone says, for the most part, says no, because it's covered by my credit card and the rental car insurance, they're making margin. Right. I guess, or I think back to a long time ago, our very younger listeners might not remember, but the AOL days, right? You dial up and AOL would always hit you like, hey, do you want our home security or our malware service? And you always say no, because they're offering you probably a subpar product and it's probably at an elevated price because they need some margin. So I guess my question is, me as a customer, Verizon comes to me and says, hey, do you want our security service? And now I think it's like $2 or $3 a month. So it is small, but me as a customer, why do I need Verizon to provide that service versus going and getting something working for the small businesses? Maybe they can't work with someone completely bespoke, but just going and getting something that fits their needs more, might be cheaper. Like I just have in my head, hey, anytime I'm offered an extra by big telco, it's always like they kind of at an inflated price and they're probably going to make a lot of margin on it. The AT&T, hey, we just sold you an iPhone. Would you like insurance on your iPhone? So why are the customers signing up for this versus doing it on their own or just going without it?
I think they're going with it. So there's two different sort of pitches around it. One is that, the internet, so this should be basically clean pipes. The telco should be delivering you pipes that are effectively clean of potential, spam, ransomware, fraud, all this different stuff, right? And clearly that's not the world that we live in. So, I think there is a real thesis around, I would prefer to access my internet connection and know that I'm not going to be bombarded with phishing attempts, that I might click a link accidentally and download something Trojan onto my device and then give away my banking credentials. And obviously, there's different levels of susceptibility depending on user profiles. But, if you think about, we all have known someone probably that we thought of as being too smart or too sophisticated to get phished, and then they did. And so, I think there is real utility to it. I think the price point of $2 per user per month is not a particularly steep one. You think about the cybersecurity budgets, right, of a lot of companies or the other solutions people might be looking at. And I think the nice thing about the Allot solution is that there's no ongoing maintenance configuration needed. You don't need to make sure you're patched and up to date. It's just running on Verizon's end, right? It's not running on your end.
Let's talk about that then. I am a small business and I sign up for it and I get it from Verizon, right? So what is Allot actually catching? Because what I had initially thought was they're just going to block it. I try and click a bad DNS or malware, they're just going to block it. But if I get phished in my email and I click on that link, how is Allot going to block that unless they're blocking the email? So what are they actually providing the service to the customer?
Yeah, there is a lot of CNC blocking that's going on. There's also the scanning of the traffic itself. So again, if someone is using a spoof on DNS or some other technique to try to get around a block list, Allot's going to catch that where other vendors wouldn't catch it. And then they'll also scan potentially for Trojans that you might be downloading. on your home network. If you have connected devices in your home, a lot of people have a ton of connected devices in their home at this point. You might have a baby monitor and camera in your child's bedroom. It'll be scanning to see if there's anomalous usage of that camera. A lot of people don't change stock passwords on these connected devices, so they get hacked at a surprisingly high rate. And then they can even get turned into like DDoS attack devices and botnets. And so it's basically scanning the traffic and ensuring that that what you're engaging with is safe and secure in the highest level.
My kids nan it, right? You hit the nail on the head. I'm near positive I did not change the password on that. It gets hacked. So what Allot's going to do is they're going to say, oh, this nanit that was, using a meg of data per second because it's a video camera, all of a sudden it's using like 5,000 megs or something. Is Allot just going to shut that traffic down? It's just going to shut that device down or cut it off and send me an email that said, hey, your nanit was probably hacked or something. Is that kind of the game plan?
Yeah, it would depend on the telco by telco, what their policy would be. But yeah, that would be my guess would be it would just be shut off. And obviously there'd be alerts and reports generated on that. But and there is a good sort of customization and configurability for people. So, they have a parental control console that comes with each of these services. And again, it's all cloud delivered, zero install. And you can be setting quiet hours. And there's other things you can use for this, but this is really the most robust form of parental control and cybersecurity. And I think that's one of the strongest use cases for consumers is that parental control, family protection elements to it. And then I think on the business side, it's even if I paid for some other products, it seems given the potential disruption to my business, if I do get phished, that this is probably a smart investment because it's redundancy, right? And this is a lot of, CISOs talk about you need redundancy. You can't rely on having, just, one security product. Like you should have multiple layers. So this is layer one. This is hopefully, even though it's layer 7 because it looks inside the packet, but it's layer 1 of your security. It's before the traffic gets to you on the telco network. The vast majority of it is going to be secure. And that's a great starting point. Now, if you have no budget for security, you can just be good with that and use nothing other than Allot's product through Verizon. If you're a bigger business or you're in our space and maybe you're dealing with big wire transfers sometimes or whatever, you probably will also pay for other services in addition to that. But I think it actually has a pretty strong value proposition, and it's just not very expensive for most people. It's affordable.
So let's go to the stock chart. And I think the two questions that I had for you, I got 2 on one side and 1 on the other, but there's going to be 2 questions. The first thing is somebody's going to pull up a 3-month stock chart. And again, we started talking December. People can believe me or not, whatever. The stock was 3. As you were talking, last night's close, it was between 750 and 8, right? So I think the first question people are going to talk about is, hey, did I miss it? And what drove this massive run over the past 2 months? So I guess I'll ask that. And then I have literally the exact reverse of the question to follow up with.
Yeah. So I would say, I do not think that anyone has missed it at this point. I mean, it's going to invite more volatility when you have a move like this. So pullbacks obviously should be expected to some extent. But I think the reason for the move, obviously, besides the fact that people knew you were doing a podcast on Allot, and
they did not know that. They did not know that. I can promise that. Don't you put that evil on me.
Yeah. So I think people. Besides that, I think the reason is that there was a period of time where a lot of these things that we're talking about were happening on the ground, but there was just no public evidence of it yet. And so a guy like me could go around and say, hey, I heard Verizon's expanding the contract, or they're going to be profitable in the quarter, but there's definitely an element of people want to see results, right? They want to see performance. And so I think now you have seen that, they brought in, they did a bunch of changes on the board, on management. They did a big restructuring to cure some of those issues we talked about with the past overspending and lack of sort of P&L discipline. And, at this point, you have a free cash flow positive company that is at a trough revenue level on its DPI business, we believe, coming off kind of a 10-year low in that business with some real growth drivers, product refresh, for example, that they just rolled out. And then you have this CCAS business, which has grown consistently at 50% plus. Recently, that growth rate on an ARR and in period basis has accelerated. We think the ARR growth is going to continue to accelerate. And you have, it's going to come in around maybe $17 million this year, 19 million of ARR, according to their guidance. And, this is growing at 50, 60%. We think it's on the cusp of some step function moves higher in the early part of next year as they turn on these new contracts. So I think the market is, especially after the last quarter, where they had their second quarter of positive cash flow generation, profitability was reached, non-GAAP and GAAP. And, I think that excited people and got people to re-rate the business from where it was trading at sort of a 1x revenue multiple up to where it is now, which is kind of like a 2.5 trailing revenue multiple. But again, we think that the trajectory of improvement is actually more rapid than the pace of the stock price increase, because it was just coming off such a depressed valuation.
Let me ask you the reverse of the question I just asked you. I used to, in my younger, more eager days, I used to take notes on every single company that got written up on valueinvestorsclub.com. It's an anonymous website. People can figure out my username pretty easily if they're really into it. But I used to take notes on everyone. So my first notes from this company were from 2015. And my last notes, I think, were from 2022. So this was written up 3 times on there. And if you read all 3 write-ups, they all make a lot of sense. They're all quite bullish. They all say the step change is coming. And all 3 write-ups were, to be frank, wrong. And like there's one from 2020 that I don't mean to pick on because I think it was very well done. But, benefit of hindsight, they said the subscription business in 2024 was going to be 120 million. And I think the numbers the company are disclosing have 2 of those 3 numbers in it. It's just kind of missing the third. I think a lot of people, the first focus is going to be the last 2 months, say, oh, did I miss it? And then the other people, including me, I'm look at it and say, oh, cool. Like over the past 10 years, the stock is flat. It's dead money. It sounds great. But I kind of look at this company. I'm like, hey, telecom vendor that for 10 years generated kind of no returns. Like what is different this time versus how it's been pitched over the past, forget the 2015 because CCAS wasn't really there then, but the 2020 especially, where it said it was on the verge of inflecting, it just never really happened. Like, why is this different?
Yeah. I mean, I think, and there's a 2023, late 2023 write-up that you can read that kind of referenced a bunch of that stuff on Vic, right? That, went into some of the past history and what's different now. But I think, again, they were going off a TAM-based methodology, looking at a big TAM and saying, we'll capture a certain percent of that, expecting customers to ramp up really, really rapidly because Vodafone had. And they just didn't have enough data to know that this was wildly bullish and that, they should not have proceeded the way they did. But I think at the same time, we have to be fair to the old board and management because they had the vision to go out there and expand into this segment. They just expanded the deal with Vodafone and with Verizon, which, that happened under new management. There's no question that that the building blocks of that were put into place by the old team and board, right? It's just, the pace of approach was overly aggressive, too much spending, too much loud expectations with the market. Now what they're doing is they're going off a bottoms up analysis. They're seeing how many people are signing up with each of these carriers per month. We have it modeled out by each of the customers that they have. How many monthly subs do we think they're adding? And the numbers are triangulated, right? And the reason why they're at 17 million or 19 million of ARR right now is because the pond they're playing in is still quite limited. Verizon, the business FWA group is 1.5 million subs. But if you vault into the 30 million subs on the business mobile side with this product that Verizon appears to have launched recently, all of a sudden you're 20xing your TAM that you're addressing at Verizon. And so that growth rate is going to increase. The other thing is with Vodafone, for example, here they were delivering a valuable service. They just weren't getting paid. And now you're getting paid beginning this year on a CCAS basis. And that's going to cause a step function. So I think you have to be pretty in the weeds to understand why it's different. And I think the cynicism, is completely understandable after the long period of disappointment. But if you're in the weeds, if you're talking to the new management team, if you're looking at the numbers on a quarterly basis over the last few quarters, I think there's a lot to feel encouraged about. And certainly, we feel that there's going to be a very strong validation of this company over the course of 2025. We're on record on your podcast and elsewhere with that view.
Let's quickly talk the management team. So they hire a new CEO in, I think it's May 2024. He was at RADCOM, which is a big telecom provider before this. But I'd love just your thoughts on the new CEO, the management team, because it strikes me like, as you mentioned, the old management team, whether it's out over their skis or they were investing aggressively into a big growth opportunity, and the telecoms can work very slow. But I just love your thoughts on the new CEO, how he's positioned the company, how you think about him going forward.
Yeah, I'm extremely excited about Eyal Harari, the new CEO. He was formerly the CTO of RADCOM, helped to lead a refresh of their whole technology lineup, reposition them for growth when they were going through some challenges. And through that, they expanded deals with AT&T and Rakuten, two big carriers in the US and in Japan. They have these huge contracts with them, recurring revenue model that he also pivoted the company to. He was promoted to CEO. During his time as CEO, he led the company to double-digit revenue growth, doubled the profit margins from around 8% net income margin to around 20%. There is about 8% of that's just interest income. A lot of Israeli companies are conservative about keeping a lot of cash on the balance sheet. And so, but I think Eyal's track record at RADCOM is very impressive. And I think, it also, the fact that he jumped to Allot, shows the type of opportunity he thinks exists at Allot. I think he would tell you that he thinks the opportunity at Allot is much more significant than it was at RADCOM because of this cybersecurity as a service solution. In addition to some opportunities on the DPI side. I think Eyal's he comes across as very, I don't want to say stern, but he's very credible. He's not someone that seems like he's getting out over his skis when he communicates. He's a technologist at heart, so he really understands technology. He understands business development and customer relationships. He's based in Tenafly, New Jersey, which I think, is across the Hudson, basically from the city. So you think about Verizon, headquarters is practically down the street from him in Basking Ridge. And so, I think that's going to come with some benefits. I think his relationship with AT&T, which was a 40% customer, by the way, for RADCOM, last I looked, that relationship potentially could lead to a deal for Allot at AT&T. And so I think there's some really good stuff in his background. I think he's very strategic. And we think highly of him, and other shareholders we think do too. And then they also brought in a new CFO, Liat Nahum, who we also think really highly of her. She's based out of Israel, which given that about 2/3 of the employees are there, it makes sense to have one of the C-level execs there full time. Eyal's there a lot, of course, anyway. But she came from Amdocs and Taboola, and so Amdocs does a lot of different things in the telco arena, obviously around billing and OSS and things like that. But I think really it's sort of a elevation of the game of the whole sort of FP&A and just financial organization that she's bringing in. And what I really like about both of them is they're young. They're in their 40s. They're people that can lead a company and there's great, obviously, older executives too. But I like looking at this company and thinking, on the 10-year, 15-year roadmap, these are people that are in the prime of their careers, entering the prime of their careers, and have a long runway for the shareholders.
Look, how I know I've been looking at like little silly telecom distributors and partners and everything too long, because in my head, when I said RADCOM, I was like, oh, that's probably a $2 billion business. And then as you said, I was like, no, there's no way a CEO would jump from a $2 billion. And then I looked and they're a little $200 million company, which, is big on ordinary scale, but it's small in the grand scheme of things.
Yeah. And
you mentioned AT&T. And I want to ask two questions about AT&T. I'd be like almost remiss if I didn't. Is there a chance that AT&T would use the same CCAS provider as Verizon? Is number one. And I guess a bolt on to that would be like, does Allot have any examples of the two kind of national champions in one country, both using them? And then the second question I'm going to ask is, I'm assuming AT&T has a CCAS offering, because in part because I Googled and they had something that looked similar. Who are they using for their CCAS offering? So I think you can address both those pretty simply, but I'll toss them over to you.
Yeah, so I do think that AT&T could switch to Allot and use Allot. Verizon also had security offerings before they came in and deployed Allot, right? They've had app-based solutions that they've run. They've had managed services from Cisco, people like that. So Allot was a new vendor because they liked what Allot brought to the table more than other people. In Spain, for example, Allot has both Telefonica and Orange. So there certainly are markets where I don't want to quite misspeak because but there are markets where they are providing CCAS to two of the leading players. So that may not be the example that is actually Telefonica and Vodafone in Spain. So yeah, Telefonica and Vodafone in Spain both use Allot CCAS, and they're very successful with it. And so
the telecom world is big, right? So and
it's a white label. Yeah, it's a white label, right? So there's things that the carrier can do to differentiate itself, and its offering. And there's an SDK you can bring in different things into the platform. So it'll never be the be all end all of a telco to just say my whole cybersecurity business footprint is run by Allot. If that were the case, then it would be more challenging for them to have both AT&T and Verizon. But I think it's very realistic that they could win AT&T. AT&T currently, they're using an app-based solution similar to many other companies, and they have DNS-based solutions as well. But no one else has what Allot brings to the table in terms of the true inline threat prevention, which is just much more robust than the DNS-based solution. And I would also say, the opportunity is big enough at Verizon and Vodafone alone to where Allot could scale this past $100 million of CCAS revenue without winning AT&T.
No, that's exactly what I was going to say. Like, I'm domestic and I know I can focus domestic, but look, as I was talking to another company that provides software to telecoms, I was like, what if you don't win AT&T or Verizon? They're like, dude, those are the hardest customers to win. If we landed one, great, but there's outside of them, there's 100 countries and there's 4 telecom players in each. And yeah, it'd be great to land AT&T, but you land 3 telecom players.
Yeah.
Question on
and they're doing that too. They just launched one in Czech Republic recently. They have some big wins in Asia Pac and probably get more there. So yeah, there's a lot of different markets.
Question on the board. I can't remember, when I introduced you, did I say outer bridge or outer wall? I can't even remember.
Outer wall was what Redbox became. We were short that one, and yeah.
You're Rory Wallace, so yeah. I think I said outer wall because Rory Wallace, and the way your name is on the Zoom for this. Anyway,
I would be outer wall, but Redbox took it when they renamed themselves. So now it's okay.
Outerbridge owns. I'm just looking at the 20F. I think there's an updated 13G. According to the 20F, Outerbridge has 7%. Claw Insurance has about 7%, and then there is Lynrock Lake Master Fund that owns 22%. So that is a large shareholding. I have no clue who that is, but they have a board. They have a board member there. Aside from them, there's not really any board membership here. I don't believe. I was looking last night. I don't believe they had to file the CEO's comp structure. So, every investor loves hey, we're giving you the stock's at 5, we're giving you 1 million options struck at 10, get this to 15 and generational wealth. So I just want to talk to you for a second about this company's shareholder mindset, right? You've got one big shareholders on the board, which is great, but no other shareholders of meaning on the board. Like most of the directors look a little higher gundy. I don't know what the CEO's comp structure is. So wanted to ask you about kind of the shareholder mindset at the company.
Yeah, I mean, I think the executive mindset from AL and Allot is they're building a big business over the long term with a lot of profitability and recurring revenue. I think we have incredible appreciation for what the board has done recently at Allot. They basically have turned over the vast majority of the board. The Lynrock's on the board. They also brought on a new chairman that we think is great, David Rice. They also brought on, before that, with our sort of collaboration, a director named Rafi Keston, who was previously COO of Radware and NDS, which was sold to Cisco for several $billion. So they have some real operationally savvy people on that board and strategically savvy. I can't speak for what I guess the Lynrock's long-term approaches on the investment, but they've been around for a long time. If you go back and look at the filings, clearly they've contributed as a director to the turnaround that's happened here. And they also have a convertible note that converts at 9:30. The company is net cash, but they have, convert that's kind of right around the money now. And so I think they have a lot of upside from the situation. And certainly if they feel like we do that this could be a, $20, $30, $40, $50 stock in a couple of years' time, I think they'll want to play for that type of an opportunity. Obviously, there are exit paths with technology software companies. There's always interest, especially for a company that's firing on all cylinders. But I think they're still a year plus away from proving that out. I don't think they want to sell anywhere below. I don't want to put words in their mouth. I don't think they're looking to sell the company imminently. Put it that way. But I do think people would love to buy it at these levels.
A reminder that today's podcast is sponsored by Fintool.com, the chat GPT for SEC filings and earnings transcripts. Just ask your question and Fintool will pull the best answer from the relevant documents, whether it's a snippet from an earnings call or a key point from a filing. If you're an analyst or portfolio manager, try Fintool today at Fintool.com and take your research to the next level. That's Fintool.com.
I want to quickly address, so the legacy, you can tell me what your valuation is, right? I will ask you your valuation actually, but let's just talk quickly valuation. We don't need to jump into numbers. I'm not going to share a spreadsheet, but when you think of value here, how much do you attribute to the legacy business and how much do you attribute to the CCAS business? And if you want to combine the two and give hey, here's what we kind of roughly think fair value is, that might be great, but that'll help with my next question.
Yeah, I think about it like I think I said earlier, and we should also probably address the Sandvine, the other large.
That's why I was going to ask about the legacy business, because I love that piece of the story.
200 to 300 million of revenue in a few years' time on a consolidated basis with a 25% growth rate and very high profit margins. I think that business trades at a 6 times revenue multiple, probably 7 times revenue multiple. If you look at
what's your basis for that? Because you mentioned Harmonics a few times, which I'm not super familiar with. If I remember correctly, that trades at 1-ish times revenue, and most of
they trade at 2.5 times. But yeah, they're really. But obviously, they have a lot of really core network hardware type business that they're selling. It's not a recurring revenue. It's a product business. It's not a recurring revenue business. If you look at
that's what I'm more familiar with, and most of those trade at
Fortinet A10. Fortinet A10. Those are good types of examples of companies that trade at several times revenue up to 10 times revenue. The more security based and the higher your growth rate, the higher your multiple will be, right? And the more recurrent. So Allot, if they have $140 million, $150 million CCAS line in a few years, and they have a other business that's doing another 125 of revenue, but it's less recurring. You can argue how to blend it out, but if Fortinet, Palo get 10 times revenue and A10 gets 3-4 times revenue, and Allot's growing at the top end of the group, I think 6 or 7. And again, there'll be real profit and free cash flow behind that too. So you're probably talking of, PE based valuation would also be a reasonable way to look at it, like a 20, 30 times multiple, depending on where the profitability shakes out.
And I think that transition is nicely. I have a hard stop at 255, so this might have to be the last question, unfortunately. But I'd love to quickly talk about the PE interest in the sector transitions nicely. The legacy business had several competitors. Their largest competitor was owned by PE, and I'd love for you just to quickly address that side, because I think it's just, I say legacy business, and you're going to say, oh, it's all going away. But I think there's an interesting catalyst on that side too. So I'd love to quickly talk that.
Yeah, I'm not going to make you late to pick up your daughter. So we basically have, the market had consolidated down to a duopoly in DPI. Sandvine found itself on the U.S. sanctions list due to sales that they made in problematic geographies and basically helping governments spy on their citizens and do censorship and things that the government didn't like. So Sandvine has gone bankrupt. They're in a stalking horse sales process to sell off the pieces of the business. They've said they're going to exit 50% of the geos that they're in, or seeds 50% of their revenue away completely. They've laid off 40% of their staff. To be a customer of Sandvine, you have to be looking for alternatives right now. And Allot is going to stand out as the strongest one. Now, it's a slow sales cycle business. It may take months to win a deal or quarters to win a deal, and then it may take quarters after that to ramp. So this issue has been around for the last 6 months, but it hasn't shown up in the P&L yet. But we do think there's real deal flow that's going to start to come through and allow that business to come back to growth. Allot also refreshed its DPI product lineup, the Terrace Service Gateway 3, which is significantly more capable, basically triples the specs of the product. So like we talked about before, this business was kind of cyclical, and you could go through 5 years where there's no growth, and then you refresh the product and all of a sudden there's some growth. So I think you have a product refresh coinciding with your biggest competitor going bankrupt, exiting a lot of its markets, and that's just a wonderful setup for them. I think it's probably not going to be like a hockey stick revenue growth because of the sales cycles and all that, but it's going to be positive for also just how the deals get priced and structured. Less pricing pressure, just more opportunity, more deals in the sales funnel. And those are the types of problems that are good ones to have, right? As opposed to what they've been dealing with historically.
No, look, I think you're absolutely spot on. And there was a cheeky little, right at the end of the Q3 call, somebody asked, hey, the non-CCAS side, what are you guys seeing? And they said, hey, it's a pretty benign competitive environment, I think was the quote. And in my head, I just think about if you're AT&T or Verizon, and Sandvine was a key supplier for some reason, and then they go bankrupt. So you've got all this, and they go bankrupt because they were selling to, they get put on a sanctions list. I have to imagine, these are huge businesses. They don't want to touch that. And I'd have to imagine that's just, if you're a salesperson, and as you said, a lot of other businesses, that business might pop up. If you were starting to win, it might pop up the next day. Here, it might not be for 18 months, but I just have to imagine, people are buying for CCAS, but go ahead.
Imagine being a CIO or CTO going to your board at year end when all these decisions get made and saying, we've got this vendor, they're bankrupt, but I think they're going to get stalking horse purchased by,
they're bankrupt because they were spying on their,
yeah. So I think there's going to be a lot of deal awards that happen. And like you said, revenue may lag that, but they should be able to at least talk about some progress on that front. We're hoping over the next, couple of months.
Perfect. Well, Rory, this has been great. Rory's joining from, are you in Hawaii right now still?
Yeah, I am. And
we have the early morning in Hawaii. Rory and I have chatted before on a separate name that at one point we might have to do a podcast on. But Rory
would love that down the road. And I just want to say before we drop, Andrew, you're a phenomenal interviewer. You do a ton of prep. Love listening to your podcast, and keep it going, man. So
I appreciate it. You're going to give me a really big head over, but Rory, this has been great. Thank you so much for popping on, and looking forward to the second one.
All right, take care, Andrew.
A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.